I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. Welcome back to the show, Tim.
Jim, as always, thanks for having me.
The U.S. Fed cutting its trend-setting rate. Why was it an unprecedented cut?
Well, Jim, my memory is so bad from interview to interview. I had, as we were talking, I thought we talked about it, but you said we didn't. But I know I covered it in the letter. And just to give people history here, the Fed actually follows the 3-month T-bill rate. I mean, that's a historical fact. They have data going back to 1946 or 1943. Fed data going back to 1943, and, it's just a matter of looking at the data. And as you move into a rate cutting cycle, there's never been a cut where they started cutting with the spread or the differential between the 3-month T-bill and the discount rate at less than 1%. I think we were at like I can't remember the exact point, and I just pulled it up in the spreadsheet, 0.92. We were at a 0.92 differential going into the Fed meeting. And in 2008, or 2007, I should say, I think the cut started somewhere around 1.5, and I'm saying that from fuzzy memory. In 2000, it started around 1.8 differential. So they let that spread get a little broader then. I think, I don't know. I mean, like I said, there's no precedence for the cut, but one thing I'd been talking about in the letter is that I didn't think that the cut would matter, and of course we sold off after the announcement. And now here we sit with a bounce, and I maintain I don't think that the cuts, and I say cuts because I think there will be more to come as these interest rates continue to decline. Back in November we saw the longer ends starting to decline, and then in April we saw the short end with when I say short end, the 3-month T-bill start to weaken, and that's what ultimately is forcing the cutting cycle. But I don't think it's going to matter here with equities. The deflationary setup that we've been talking about with collapsing commodity prices, the inversion of some of the yield curves, the declining interest rates, the entire setup that began in 2018 is continuing to take place. So I think there will be more cuts to come, but I don't think it's going to matter.
Why don't they matter?
Well, it's an attempt to reliquefy, obviously, but the fact of the matter is that the reason why I say they don't matter is if you look at the charts, it's a simple matter of looking at the charts in 2000. And they cut, and I don't have the numbers in front of me, but I think we were at like 7.5 or 7.75 or whatever the number was, and they cut all the way down to wherever they cut. I can't remember, around 2% or whatever it was. And the market still declined. It didn't stop anything. And we had a 39% decline, I think, in 2000 to 2002. And then you look at the 2008 decline, and they cut. I don't have the numbers in front of me, but I want to say we were in the 6% range, and they cut all the way down to virtually to zero, and the decline still occurred. It didn't stop anything. The decline did what it did. I think that is. I mean, when you look at the data, it's as simple as overlaying the data, one chart over the other, and you don't see anything. The cuts are temporary in nature, if anything at all. And when I say temporary, I mean they cut, and okay, maybe it bounces for a few weeks type thing, and then the decline continues. So what I'm saying is I think the reality is that the market is independent or somewhat independent. In other words, once that setup occurs for that top, the rate cuts don't really matter. Now, I do think what mattered was following those rate cuts was the stimulus that occurred, after the fact, when we got into, after the bottom was made and the market kind of floundered some, they started the QE. I mean, obviously those practices help, but I don't think the rate cuts, the data just suggests the rate cuts simply did not work, and this one didn't, and I don't think the future ones are either.
Well, if low interest rates and negative interest rates help, how come Japan's economy has never recovered from the early 90s?
That's a good point. And what we're seeing here is that this is a deflationary setup, a deflationary backdrop. If the economy was expanding, think about it. Back in the 70s, when interest rates were high, we had real inflation. So, and now, with interest rates declining, that's deflationary, not inflationary. And so, I think it's a sign of the times, and it's not a cure for the market.
Well, with deflation as well, we're seeing home prices in Vancouver drop dramatically. I understand places like Manhattan and San Francisco and LA with top-end real estate, that's come down quite a bit as well. Is that another sign that the economy is slowing down when the rich people stop buying really expensive homes?
Yes, I think this is all, look, we've talked about this from different angles, and like I said, I can't remember from one interview to the next exactly what we talk about, but we've talked about this bubble for quite some time, and I maintain. I know it's from, people maybe get tired of hearing bubble, but you know what? That's what it is. And we've been watching this setup come together. We watched it ramp up into 2018, and if you will remember, we had a top in equities in January 2018, and then I've mentioned this numerous times, but the dollar bottomed in February, and I said that was a pivotal event, that bottoming of the dollar in February, and it was from that February low, the January high in equities, where this entire topping process began. And so what we saw throughout 2018, remember me saying this, that if you looked underneath the surface, in other words, I said that the industrials and the S&P that everybody's got their eye on, it continued to actually even work higher into October of last year, but everything else was breaking down. We saw, and everything from the Canadian market, the FTSE, the emerging markets, all of that was, none of those markets were confirming, and we saw soft commodity prices and so on and so forth. In November, like I said, we saw the monumental shift in interest rates. That was where, it was looking at a chart like something happened, something broke, and you can see where the longer term rates stopped advancing. It's like they hit a wall and the decline started. So it's been a long process. But anyway, that said, we saw the leaders set the stage for the decline into the December low. Everything pretty much declined into the December low, equities, and commodities, everything. And then we bounced. Well, since about April to May, what we've been seeing is the same thing we saw in 2018, in that, okay, the industrials and the S&P are, they've continued to camouflage, if you will, the structural breakdown that we're seeing in some of these underlying indexes and averages. And, I think we've talked about this, that, raw materials prices just continue to collapse. They have declined below a significant cycle low, a longer-term cycle low that was made back in December, or January in their case, in conjunction with the long-term low that was made in equities. And now we've seen the CRB index itself confirm that. And so all this stuff underneath the surface is again beginning to roll, to soften. And so it's the same thing you're seeing there with housing, but yet, just like with that initial top in 2018, nobody's paying attention. Everything's camouflaged because the Dow and the S&P haven't quite cracked yet.
We'll have more with Tim Cyclesman Wood right after this.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're talking to Tim Cyclesman Wood. Tim, with the bounce we're seeing back in the market, is this a permanent fix? Have we seen enough of a correction?
Oh, no. If it's going to be saved, this is the point. Like I said, the Dow and the S&P haven't quite cracked yet, but I think they're on very, very, very thin ice. Like I said, we saw the interest rate cut was pretty much a failure. We've of course we had that decline, and now we're seeing, I think, literally what is a bounce. But I think in the grand scheme of things, the setup is still underway. And when I say thin ice, I mean literally thin ice. This is getting, I don't know, I'm trying to choose my words, dicey. The risk level here for equities is getting very high. I just think the risk is high, and this could turn quickly. So no, I don't think the decline is by any means over, and that we saw a significant bottom. I just no, I'm not in that camp at all.
We won't have to wait for the winter of discontent. It could be very much a fall of discontent.
Yes, a fall of I think we are setting up for that sort of thing. And, like I said, it's a matter of containment. It's like, to explain, I mean, the setup is happening. It's undeniable. Like I explained a while ago, the industrials and the S&P are providing cover for all this other stuff that's taking place. I mean, and one by one, we're seeing the dominoes fall. We've, like I said, the raw materials led the way. We've got numerous indexes and averages that are structurally much, much, much weaker than, the industrials and S&P. We've seen the CRB confirm. We're seeing, all these dominoes, like I said, one by one falling in accordance with this longer-term setup, but equities aren't quite there. And the danger is that when you're in this environment, it can happen quickly. You wake up one morning and you look at some of these charts that you see where these big gaps occur. Well, they don't just occur out of the blue. The setup has to be there. And that's what I'm saying is that it's there now. Now, does the market do that? Is that opportunity for the bear, if you will, is it taken? Well, I don't know, but the opportunity is certainly there, and that's what makes it so dangerous, is because it can just turn so fast.
We'll have more with Tim Cyclesman Wood right after this.
Grand Portage Resources' Herbert Gold Project in southeast Alaska highlights increased gold resource, indicated and inferred, of 860,000 ounces, in excess of 10 grams per ton gold. Expansion drilling is planned on the Herbert Gold property for the summer of 2019. Grand Portage Resources trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Tim Cycles Van Wood. Tim, with the markets poised on perhaps a major correction or something even much worse, what's going to happen with gold? So many people feel it's a safe haven.
I know, and I get that. I admittedly, I openly will tell you, every indication was that the 9-year cycle top was in. We talked about that, ever since that evidence first appeared, and back in 2016. And so this advance I was not expecting, but to put it in context, here's the problem with it. I'm not standing in front of it. As a matter of fact, I was just looking at last month's newsletter as I'm writing this one, and I made the comment there that you can't stand in front of a buy signal. I mean, you get run over like a freight train. So on the one hand, absolutely, I admit that we have and as of this interview, we still have an intermediate term buy signal on gold. But here's the problem. When I put it in context, I think it's counter trend. I don't think it's sustainable. I think it was a retest of this 9-year cycle top, and maybe it is coming from the fear of the market. Maybe gold is sensing that something isn't right. I mean, absolutely. But I don't think it's sustainable, and I'll tell you why. Here's the problem. It's real simple. If you look at the price relationship with gold, the base metals, gold, raw materials, gold, the CRB, they track, by and large, they move together. The cyclical rhythm is by and large the same. Of course, it's not tit for tat. Of course, there's always a leader and a laggard, just like we talked about with, the Dow and the S&P versus all the other indexes on the planet. But the basic cyclical rhythm is the same. And, something always has to turn first, and something, the magnitude of, in one, the move may be a little more, a little less than the magnitude in the other. But it's the same, and ultimately, they get in check. They're back in sync, or however you want to say it. And so, that being said, and looking at what's happened with the raw materials and now the CRB index, gold's the odd man out. I think it's going to get back in check. And so, on the one hand, and I'm not talking out of both sides of my mouth, I mean, you have to work both ends of this to the middle, but on the one hand, yes, we have an intermediate buy signal. And yes, I think it was another push into a 9-year cycle top. But you can't ignore these facts either. So what I'm saying is that once gold begins to soften, and when you see, I get an intermediate term sell signal type thing, then that also has to be respected. I just don't think it's sustainable. And if you look back in 2008 and think about this, as the market was declining, I guess you could argue that gold was a safe haven then. Everybody went to gold as the markets began to decline. But look what happened to gold. It peaked as well. Now that was a major top, major run up, but I think we're seeing something fairly similar.
When interest rates go down, does the U.S. dollar follow it?
Yes, Jim, as a rule, yes. Again, there are, lags in the turns, but as a rule, if you're looking at a chart, the dollar does tend to want to bias toward, the interest rate cut. I'm looking at an overlay of the dollar and the discount rate. And like I said, the turns are not, precise, and sometimes it can take a couple of years even before the turns actually occur. It's almost like the cyclical rhythm is shifted. So on the one hand, where you may be going with this is you say, well, if you cut interest rates, then shouldn't that peak the dollar? And the answer is yes and no. I think yes, but not yet. I think yes, but not yet.
Crude prices, are they on their way down?
Absolutely. Crude prices, I had said that I thought that the advance in crude oil out of the December low was counter trend, just like just like with equities. The cyclical rhythm is pretty much been the same. We saw some non-confirmations, if you will, between crude oil and equities with this last advance. And like I said, the cyclical rhythm is pretty much the same, but then when you see that non-confirmation, it's a warning. And now we've seen crude oil soften significantly. It's bouncing a little bit today, but the structure, it looks like that it has changed, and it is poised to move lower in conjunction with the CRB and raw materials.
Tim, thank you so much for chatting with us.
Thank you.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. If you have any questions for Tim or any of our other guests, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.